Hey everyone, I'm Alex Morgan, and right now, as you're watching this video, silver is trading at $91.83 per ounce on the US market, and something very significant is happening. Something that every trader, every investor, and every person who has been watching this market over the past few weeks needs to understand clearly, because what is unfolding today, February 25th, 2026, is not just another price move. It is a defining moment for one of the most explosive, most unpredictable, and most talked about commodities on planet Earth. And if you don't know what to look for right now, if you don't understand what these price levels mean, what the $90 breakout represents, and what could happen next, then you are flying completely blind. So stay with me, because by the time this video is over, you're going to have a full picture of exactly what silver is doing today, why it's doing it, and most importantly, where it is likely to go from here. Let's start with the number that absolutely shocked the world. On January 29th, 2026, less than a month ago, silver hit an all-time high of $121.64 per ounce. Let that sink in for just a second. $121.64 per ounce. That is a level that most analysts, most institutional investors, and most market veterans said they would never see in their lifetimes. Silver had been climbing sharply through late 2025, but nobody, and I mean nobody, was prepared for the velocity of that move in January. The surge was fueled by a perfect storm of retail investor enthusiasm, massive short covering by institutional traders who were caught offside, and a growing narrative around industrial supply shortages that had been building for months. It was the kind of market event that happens once in a generation, and then, just as dramatically as it rose, it collapsed. Within a single week following that all-time high, silver crashed approximately 36%, plunging all the way down to around $63 to $75 per ounce, depending on which moment you were watching. It was one of the most violent corrections in silver's history, the kind of move that wiped out leveraged positions overnight, that caused margin calls to fire across brokerage accounts, that left retail traders staring at their screens in disbelief. U.S. Treasury Secretary Scott Bessent stepped into the spotlight to address the chaos, attributing the extreme volatility specifically to speculative activity, and pointing the finger partly at Chinese traders who had been driving both the ascent and the violent reversal. The precious metals market was shaking, confidence was shattered, and for a brief window of time, many people believed the silver bull run was finished. But here's where the story gets interesting. Here's why you're watching this video today. Silver did not stay down, it bounced, and not a weak, fragile bounce, a relentless, grinding, week after week recovery that has now carried the price from those crash lows all the way back to $91.83, already. As of this afternoon in the U.S. session, that is an extraordinary move. It reflects something more than just short-term speculation bouncing back. It reflects real, physical, structural demand from industrial buyers who need silver to manufacture the products that power the modern world. And that distinction between speculative demand and industrial demand is the single most important thing to understand about where silver is headed next. So what is actually driving silver right now today on the fundamental side? The first and biggest driver is solar energy. Photovoltaic solar panel manufacturers consume more than 25% of the entire global annual supply of silver every single year. And with governments across the United States, Europe, China, and the developing world pushing aggressive, renewable energy transition targets, that number is not going down. It is going up. Solar installations are expanding at a pace that was unimaginable just 5 years ago. Every single panel requires silver paste for its photovoltaic cells. There is no substitute at scale. Manufacturers are not shopping around for an alternative. They are signing long-term supply contracts and locking in silver at any price they can get because they cannot make their products without it. The second driver is electric vehicles. EV-related silver demand surged approximately 20% in 2025 alone, and that trajectory is continuing into 2026. Every electric vehicle uses silver in its electrical systems, its battery management circuits, its charging port contacts, and its onboard electronics. The more EVs hit the road, the more silver gets consumed. And global EV adoption is accelerating, not decelerating. This is not a trend that reverses. It is structural, it is multi-decade, and it is happening right now. The third driver, and this is the one that most commentators are still sleeping on, is artificial intelligence infrastructure. The data centers that power AI systems require silver in their high-efficiency electrical components, their thermal management systems, and their advanced circuit boards. As AI investment continues to pour in at a historic rate, the demand for the physical materials that make AI infrastructure possible is growing in lockstep. Silver is quietly becoming one of the backbone commodities of the digital economy, and most people haven't connected those dots yet. And all of this demand is colliding with a supply picture that simply cannot keep up. Silver is currently in its 6th consecutive year of structural supply deficit. That means that for 6 years running, global demand for silver has exceeded global mine production. 6 years. Every year the gap has to be bridged by drawing down existing inventories, and those inventories are getting thinner. Mining companies cannot simply flip a switch and produce more silver. Most silver is mined as a byproduct of copper, zinc, and lead mining, which means production growth is limited by decisions made in entirely different commodity markets. The supply crunch is real, it is documented, and it is not going away. Now let's talk about what the chart is telling us right now. Because today, February 25th, 2026, silver is sitting right on top of one of the most critical technical battlegrounds it has faced since the crash. The price as of this afternoon is 91,083. Hovering right at a major resistance zone that analysts across FXS Street, Light Finance, and multiple technical platforms have been flagging for weeks. The key number to watch is $91 to $92. That range represents the neckline of what appears to be a developing cup and handle pattern on the daily chart, a formation that, when it completes and breaks to the upside, is one of the most powerful bullish signals in technical analysis. Here is how the levels break down. To the upside, the first critical resistance sits right around $90.87 to $91. Silver has been testing this zone multiple times in recent sessions, and today's move to $91.83 is a meaningful push through that level. If silver can close today's daily candle firmly above $91, not just touch it, but actually close above it, that would be a technical confirmation that the breakout is real. From there, the next resistance target is around $92.80 to $93, which aligns with both the algorithmic forecast from CoinCodex projecting a move to $92.80 by March 2nd and the mid-January peak level that technical analysts at Finance Magnates have identified as the gateway to the $100 psychological barrier. And yes, $100 is the next major target that the entire market is watching. Light Finance's technical model shows that a confirmed close above $92 opens Fibonacci extension targets at $100 first, then $109, and ultimately back toward $121, the all-time high. If silver reclaims $100, the media attention alone will pour fuel onto the fire and attract a new wave of investors who missed the January run. To the downside, the key levels you must watch are the Pauser pivot point at $86.98. This is the line that separates the short-term bullish structure from a neutral reading. If silver pulls back and loses 86.98 on a daily close, the momentum stalls. Below that, support sits at $85.10, a level where significant buy orders are expected to defend, and the truly critical floor is 83.00. A daily close below $83 would be a warning signal that the recovery is running out of steam and a deeper pullback toward the $75 to $77 zone is possible. But here is the nuance that separates an informed reading of this market from a superficial one. There are exactly 7 key indicators that analysts are tracking right now, and 4 of them are leaning bullish, while 3 are urging caution. On the bullish side, silver mining stocks represented by the Global X Silver Miners ETF are trading above $107 and are holding their ground strongly, which is historically a leading indicator that the underlying metal will follow higher. COMEX silver futures are in backwardation, meaning futures prices are actually trading below spot prices, which is a rare and significant signal that physical demand for immediate delivery is genuinely urgent. There is also a notable divergence between the US dollar index and silver, with silver holding its ground even as the dollar has shown intermittent strength, a sign that real buyers, not just dollar weakness opportunists, are driving the price. And perhaps most importantly, hedge funds are barely positioned in silver right now. Managed money accounts, the big institutional players, largely exited or reduced their positions during the January chaos. That means there is a massive wall of uninvested institutional money sitting on the sidelines, waiting for confirmation before re-entering. When they do come back in, the buying pressure could be extraordinary. On the cautious side, COMEX open interest in silver futures has been declining, meaning fewer contracts are being opened, which suggests that futures market participants are not fully committed to this rally yet. There is also a hidden bearish divergence on the RSI, where the price has been making lower highs while the RSI forms higher highs, a subtle signal that momentum might be flagging even as prices recover. And the gold-silver ratio is showing a potential bullish flag for gold, which could mean capital rotates back into gold and away from silver in the near term. So what does all of this mean for what happens next? Here is the most honest and complete picture this market is painting right now. The most probable path through the rest of February and into March is a consolidation phase between approximately $83 and $92, a base building period where the market digests the recovery, shakes out weak hands, and rebuilds the confidence needed for the next leg higher. If silver breaks and closes daily candles above 92E, that is the green light. That is the signal that the cup and handle has completed, that institutional money is beginning to re-enter, and that the path toward $100 is open. A move to $100 by mid-March is realistic under that scenario, and if $100 holds, the extended Fibonacci targets of $109 and ultimately a retest of the $121 all-time high come into play. The macro environment is supporting this scenario as well. The Federal Reserve is widely expected to hold rates steady in March, but markets are pricing in 2 rate cuts. Later in 2026, rate cuts are historically one of the most reliable catalysts for precious metals. As rates fall, the opportunity cost of holding non-yielding assets like silver declines, making the metal more attractive to institutional portfolios. Physical demand from industrial buyers is also providing a real floor under prices rather than purely speculative leverage, which gives this recovery a fundamentally different character than the January spike. The bearish scenario, and you need to understand this clearly, gains traction if the US dollar index surges above 100. If upcoming jobs and inflation data come in much stronger than expected and force the Fed to signal a higher for longer stance, or if the gold-silver ratio breaks sharply in gold's favor and pulls capital rotation away from silver. Any of those catalysts could send silver back toward $83 and potentially toward the $75 to $77 zone that served as the crash low. The institutional forecasts are widely spread but skew bullish. Bank of America's head of metals research, Michael Widmer, has maintained a forecast that silver could reach between $135 and $309 per ounce in 2026, a range so wide it reflects the genuine uncertainty in this market, but also the enormous upside potential. JP Morgan is projecting silver to average around $81 per ounce for the full year, while more aggressive models from CoinCodex are targeting $92.80 by next week alone and as high as $398 by year-end under their bull case. Silver has already surged more than 150% over the past year, hitting its highest levels in over a decade, and many experts forecast further upside potential pushing silver toward new record levels. The bottom line for today, February 25, 2026, is this. Silver at $91.83 is sitting at a crossroads. The bulls need a confirmed daily close above $92 to validate the breakout and open the door to $100 and beyond. The bears need a rejection at this level and a drop below $86.98 to regain control and push toward a retest of lower support. The fundamental picture: 6 years of supply deficit, surging industrial demand from solar, EVs, and AI, and massive uninvested institutional capital waiting on the sidelines argue strongly that this metal is not done moving higher. The technical picture says the next few daily candles are going to be critically important. Watch $91 to $92 like a hawk. That is the line between a breakout and a breakdown. And whatever happens at that level is going to set the tone for silver through the rest of February and well into March. This is the moment. Pay attention.